Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. After the second quarter brought another quarter of negative growth, many investors are wondering if a recession is right around the corner. Joining me to discuss is Dave Alison, president of C2P Enterprises. Dave, it's great to have you with us. Welcome to Trade Talks.
Thanks for having me, Jill.
What are the top 4 behavioral mistakes investors make?
Well, I think the first one is that they just have a lack of a plan, right? At the end of the day, we know there's a lot of uncertainty in markets. And so we tend to see those people that actually have a well thought out plan are the ones that have the ability to stay disciplined when things go sideways. They also have some maybe dry gunpowder to be able to take advantage of opportunities in dips like we're seeing right now. And so I think the biggest mistake is people accumulate a whole bunch of investments, but they really don't have a plan in place of how all those investments work together. So, that's a big one. The second one kind of goes hand in hand with that, in that they allow emotions to control their investment decisions. And so, the end of the day, none of us like seeing our account balances go down. We all hate losing money. In fact, there's incredible studies that are done that, people hate losing money more than they actually like making money. And so when they see their balances go down, they tend to allow emotions to take over. They act irrationally. Maybe they cash out of otherwise good investments or good stocks or companies when the markets are down, in terms of, really just, driving that behavioral component of things. So that's another one. I think the third is that, sometimes they just bury their head in the sand and don't do anything. And so they don't make strategic moves in their portfolio. They don't capitalize on things like tax harvesting or Roth conversions. And so they just kind of bury the statement in the drawer, and they don't want to look at things and take advantage or capitalize on opportunities. And then the fourth one is just, kind of going either too conservative or too aggressive in their overall decisions. And so, again, not really having a proper allocation or framework. They can see the volatility, and it could cause them to maybe make a move too conservatively and ultimately miss out on a recovery. We saw that maybe over the last 30 or 60 days. We've seen this kind of bounce back from the market lows. And people in May that might have panicked and gone too conservative have now missed some of that rebound. And so those are the big 4 that we typically see.
And that's a great point. I mean, look at the opportunities that we had off the COVID lows, off of the June lows. I mean, those shares that we acquired in our 401ks and other investment accounts, I mean, sometimes those can be generational opportunities. So, Dave, my question to you is, what can investors do to combat today's economic threats while also preparing for a potential recession?
Yeah, it's a great question. So at the end of the day, we know recessions are just part of a normal economic cycle in some way. I always tell my clients it's not a matter of if, it's just a matter of when. And so we need to be prepared. And, we utilize approach of kind of thinking of all of our money in 3 simple buckets. I think people have the ability to mentally compartmentalize their money. And when they do that, it allows them to make better financial and investment decisions. And so, if you think about the simple concept of compartmentalizing or bucketing your money, we like to think of it as your now bucket, which is your money in the bank. It gives you a nice runway, maybe 12 or 24 months of cash on hand, so that you can deal with these short-term market fluctuations. Your soon bucket is any money you may need or will need sooner rather than later. And because it has a shorter time horizon, you want to take less market risk or volatility. And then, of course, your later bucket is now where you can have the confidence, the time horizon, and the peace of mind to allocate your investments towards long-term growth. And you opened up by sharing, what can investors do? I think that's a key word. There's a big difference between an investor and a trader, right? Traders are trying to make short-term profits. Investors generally need a longer time horizon for those investments to pay off. And that's what that later bucket can do for them. And so I believe time segmenting your money, creating those different buckets, allocating the right amount of capital to each bucket so that you don't have to worry about the day-to-day, month-to-month, quarter-to-quarter market volatility that exists.
Right, and Dave, that's such a great point that you bring up. Whether you're a trader or an investor, time frame is so key, even just as important as picking which investment to put in your portfolio or what trade to take. A time frame is everything. It's a very different mindset when you're thinking 5, 10, 20 years down the road versus, every quarter, annually, when you're looking at your retirement assets. And I think the way you've broken it up into the different buckets helps to eliminate those risks and keep investors on track longer term.
Absolutely, it certainly does. And I mean, we've all seen the academic studies out there. Dalbar produces a great one that just shows what the average investor's return is typical to even just market indexes. And the reason that the average investor generally underperforms is they allow emotions to control their investment decision. And so having that time segmented, it's just like if you were a trader, right? Trading 101 is trying to figure out the entry point to get in and then being disciplined enough to get out once it hits your price target. But the reality of it is, when we put money in a stock and it's going up and up and up, most of us don't have the discipline to get out. And that coincides with things that exist in today's environment, like even just kind of strategic rebalancing. Right now is a great opportunity. We're in a weird market environment where fixed income is down because of the interest rate moves. Equities are down comparatively to where they were last year. Certain sectors are way down, like technology. That whole discipline of buying low and selling high, even in a very broad, diversified portfolio, can be achieved through rebalancing. And that's something that not a lot of investors are doing right now because they're more buy and hold, or they're not looking at what they should take gains on and how they should reallocate it into asset classes that have underperformed, which is a big opportunity for people to improve their situation today as we look at expected return over the next 1, 2, 3 years into the future.
All right, Dave, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.